Finally, the market saw some cleaner movement on Friday, breaking key support levels in the S&P 500. I'm hopeful that this kicks off a sustained downside move, but honestly I have some doubts, simply based on the fact that Friday really wasn't all that bearish if you just look a little bit deeper than surface level price action. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, we do have a bearish inverted hammer because the body, of course, is red. That means that the opening print is over the closing print of the bar, basically meaning that in the upper wick we did find some serious sellers there. They pushed prices back down to the open, through the open for range expansion in the downward direction, and the sellers did get a fairly weak close towards the lower third of the overall range here, so sellers are in control structurally. If we're thinking about location on the bar-to-bar count, notice that we do offer a very nuanced lower high as well as a lower low, and we did close this week's range underneath the previous week's range. So sellers go 2 for 2 on the weekly structure and location, and this is fairly important because the weekly thesis we've set forth over the last couple of videos really is that this 3-week balance range is possibly going to act as a look above and fail. And in theory, if we fail back down into the range, and remember that this is the original 3 weeks right there, then the bottom end of that range is the hypothetical target. When you fail back into balance, you target the opposing end of balance. And that would be the top end of the China gap as well. The weekly 50 SMA, the blue moving average on your screen, is there to meet us. If we close the China gap, it's a little bit deeper to about 570s, a little bit underneath that actually. We'll take a look at that on the daily. But generally speaking, this week's close is back inside of the box. So on the weekly timescale, there's a reason to believe that the market could potentially move lower here. The only issue is, for stronger sellers at least, is what's the trend? We still know that the trend is lows, higher lows. This is a soft higher low on the weekly. Of course, we had highs. This was the most meaningful higher high, and we're pulling back from the highest high in the weekly trend count. So is it like there's a massive threat for a weekly downtrend to emerge here? Not really. If we fail back down into the 3-week balance range here, which we've closed basically right on the edge, the daily chart will see it as slightly underneath. If we are going to pull back to the bottom end of the balance range here, it's a great opportunity for a weekly higher low, and I would still maintain the higher time frame bullish outlook here on the S&Ps. If we come in here with a couple of supporting evidence bits or just other technical indicators, you can see that we're still well above the anchored VWAP stack, even from the April sort of tariff panic down here. All of that, the top end of the stack, is still going to act supportive over the top end of the China gap right here, which is again much closer towards that 570 area in the S&P. If we take a look at the Fibonacci's, of course, from the bottom end of the move here up to the high, we'd be well over the Fib 38.2, even if we close the China gap all the way. If we take a look from the all-time high down to the low, not that this is going to change very much, we'd still be well above the Fib 61.8. So although there is the opportunity for a mild pullback to develop on the weekly timescale, it's not enough to really change the weekly trend in a major way and say, okay, let's like buckle up, the weekly trend is down, the market's going to be much more susceptible to a major move, something like down 20% over the span of the next couple of months. I'm just not really seeing it as the weekly trend remains in the upward direction. Let's quickly throw on the volume profile here from the weekly perspective and just make note that the high volume node here is the bottom end, or the bottom end of the high volume node, I should say, because this is one big cluster, is the bottom end of the balance range that we'll be targeting if the weekly does see continuation underneath last week's low. So the way I would play this on the weekly, if you're really from a swing time frame perspective using the market's from that point of view, I would say if we're underneath last week's low, I would certainly maintain a little bit of a short-term bearish outlook looking for the bottom end of the balance here, but that's only based on price. As I mentioned in the intro, it really wasn't that bearish on Friday, so let's continue down through the time frames. Grabbing the daily time frame chart here, let's firstly evaluate this week's expected move. Let me orient the chart a little bit more cleanly, that way we're not looking at some funky price action. Here we go, look at that. Beautiful, right? So the weekly expected move is this gray box right here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 60607, and that actually implies a slightly higher high than the highest high of this move, which came from the Wednesday CPI gap up of what was now 2 weeks ago. If we look to the lower edge of the weekly expected move, the number is at 582.49, of course, implying a lower low in the trend count, much closer towards the bottom end of this gap from back over here. So the expected move strikes me as being somewhat neutral because of the higher high and the lower low. Now, if we just take a minute to talk about the trend of the daily time scale, this was really the last major daily higher low in the S&P 500, and now that we've finally fallen back down into an hourly downtrend, it's very possible that we could still sustain a daily higher low even if we do not hold up over this key level right here at 595.15, which 595.15, by the way, is the top end of the 3-week balance range, right? If we do something that looks like this, that's the 3-week balance range, and this is the close ever so slightly underneath the top end of the 3-week range. I think the most important thing to call out here is that this does technically take out the low of the previous Friday bar. Of course, that's what we saw with the weekly close underneath the previous week's range. And in theory, this starts to suggest any sustained action underneath the 595.15 should look for bearish consolidation and then follow through to here. Once we get to 585, you would look to close the remainder of the gap, and then I would really start reevaluating, because remember what we said on the weekly timescale. Is it possible that we could set some sort of weekly higher low if we were to pull back towards the bottom end of balance? The answer to that question was absolutely yes. So in the short term, the more time we spend below 595.15, the more I would be inclined to say, okay, we have look above and fail in the higher time frames. We're looking for the market to pull back a little bit more deeply, and we're looking for some of these key supports to start stepping up. 588, top of the gap 585, and then the bottom of the gap, which is here at 581.50, lower edge of the weekly expected move. Now, on the flip side of this coin, because as we'll see through the supporting evidence, if the market moves higher, which there's actually a decent chance that this was an overblown move on Friday, I'll show you why in just a moment. If the market looks back over 595.15, holds above that level, this will ultimately become a daily higher low in the trend count, and when the hourly trend flips back to up, I would maintain that the daily trend is looking for continuation towards, at minimum, the equal high, if not over time, the all-time high, which is slightly off of the screen right now, up there at 613. So let's get a little bit more, more nuanced, and let's take a look at the hourly chart, because this is really what I think is going to hold the key early on in this upcoming week's session. So if you look at the hourly time scale here, all of this really just acted as balance over the top end of the 3-week range we've just been talking about. Now, on the Friday session, you can see that we had a liquidation break off of the open, and there was some lower high price acceptance here underneath the two equal lows from really Tuesday and Wednesday's session. Remember, Thursday was a holiday at 596.85. The more time we spend underneath that, once again, underneath this 595.15 as well, if we're here, bears absolutely in control in the short term. If we get something that looks back over 595.15 and can look like this, I would start thinking about breakout trades or just long-sided trades over the recapture of this level here at 596.85. This would start to look like a higher low double bottom in hindsight, and over this level here, the hourly trend starts to flip back to up, right? If we set some sort of higher low, and then if we can break over this area of potential resistance, that would start to bring in a higher high in the hourly trend count, because the hourly trend right now is down, right? We have highs, we have lower highs. This in theory could act as a lower high, but we have lows, lower lows, and undoubtedly on Friday, lower lows. So it's all good from a trend counting perspective. This is now giving the opportunity for a firm daily higher low. We'll bring out the DHL shipment, but if this is going to be short-lived, this is kind of the reversal that I would look for back in the upward direction. So first step is price acceptance back over 595.15, then a break over 596.85, looks for long side follow through, basically back up to the equal high. That way the daily trend can persist as up. If the market's going to be more bearish, as we've already described, it's consolidation here, and then it's Brigade bolts underneath 592.50. This is fairly thin structure retracement back here. Under 592.50 targets that 588, and then below that, we're starting to talk about the top end of the gap from over here, which is down at 585, and then 581.50 is the true gap close to the high of this bar from way over here. That's what we have in the downside. If we take out our Fibonacci's from the bottom end of this move here up to the top of the move, any confluence, we've basically pulled right back to the fib 38.2. One subtle, very, very subtle reason to say, if we were to pop back up and over 595.15, I really wouldn't maintain a very bearish stance on the market for very long. The less time the market spends underneath 595.15, the more likely I think it is that this is just going to look like a daily high or low in hindsight, and we want to maintain the stance that the daily trend is going to continue and ultimately battle its way back up for the equal high over time. So fib 38.2 aligns with the idea that we do not want to overstay our welcome on the short side if the market is not accepting underneath 595.15. Let's clear that up. Let's take a look at the intraday anchored view apps. What you'll notice here is that the market is continuously rejecting this recent and local high anchored view app. So if we're under that, you might say, okay, if we're getting, like the idea would be, if we get this, you would target 599.25 and then you would reevaluate at that level. Is it possible the market continues to reject there, which would maybe subtly align with the anchored view app? It's possible. So on the long side, we definitely want to treat these targets with respect, but you'll also notice, right, what's the flip side of the same coin? The market really didn't break down all that aggressively through these anchored view apps, which really have been set based on the lows that anchored this entire move post-China gap in the upward direction anyways. So you have confluence right now at 592.50 with the anchored view app, as well as 595.15, which is the ultimate key daily level. If you're above 595.15, you're above the bottom end anchored view apps from this move higher, really wouldn't maintain that more bearish stance as we've already outlined here in the S&P 500. Let's just play devil's advocate and mention why it is, I believe, the correct idea to start with a bearish stance, but you have to be very skeptical of that bearish stance on Monday. If we open underneath the 595.15, what would that suggest? Well, we opened on Friday over both of the key levels, right? 596.85, 595.15. Put yourselves in the shoes of a buyer on that Friday session. In a picture perfect world, you would have just rallied, recaptured 599.25, and rotated up here for the move in the upward direction. Clearly didn't happen. The next thing you would have liked to see is a little bit of an overshoot of the two equal lows, and then maybe some sort of Brigade bolt back inside of range for a move in the upward direction. That also didn't happen. We did not see firm support at the 595.15, and the afternoon consolidation was underneath. The only way in which this is immediately going to be bullish on the Monday open is if the open is substantially over 595.15, because think about it from this perspective, anybody who's short late to the party into the end of the week holding things over the weekend is going to open up in a world of hurt if the market ends up opening over the two equal lows from Tuesday, Wednesday, or just even over 595.15. So that really has to be the arbiter of price if we're looking for early week action, 595.15, over or under based on all the confluence that we just talked about. So what else do we have going on here in terms of supporting evidence? Here's the market internals for the NYSE side of things, If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. What do we see? Primarily on Friday, when the market broke down, is what we care about. Did we have substantial volume outflows? Answer, no. Did we have an advanced decline line in trend lower zone? Answer, no. Did we have substantially bearish cumulative tick or just tick action in general? Answer, no. So once again, if you look slightly deeper than just price itself and what we just saw there in the S&P 500 chart, if you look just a little bit deeper than this, what you'll actually see is that the market really wasn't all that bearish. We had a little bit of news early on in the day about semiconductors, which obviously dragged NVDA lower, the SMH, semiconductor ETF lower, being a really heavyweight component of the S&P. Of course, the market sold off a little bit, but outside of that, it really wasn't that detrimental of a session. If we go back over to the market internals and we take a look at what was happening earlier on in the week, this really isn't all that bearish. It's much more indicative, Wednesday all the way back to Monday, it's much more indicative of balance, more so than any sort of major trending action in the market. So, baseline question for the internals, final question here. Do we have stronger sellers, more aggressive sellers starting to participate at the exchange level? The answer to me has to remain no. And for that reason, as I've said in the S&P 500 cash here, if we end up opening over this level, I do not think you want to maintain an overly aggressive bearish stance. If we're below, we'll look for some of these Brigade bolts, but again, even at these levels, I would start thinking about, is it possible for the trend to end there, the hourly downtrend to end there, and where ultimately does the hourly trend flip back to up, in which case we're seeking the daily high or low in the overall move. Let's continue along in terms of supporting evidence charts. This, of course, is our market market profile. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. What I would call out about the session on Friday is that we did have liquidation break. Liquidation break is not necessarily indicative of stronger sellers. It's indicative of longs who are tired, and that's been a theme of this market, right? We've talked about this for the past couple of weeks, that longs positioned towards the highs, they really have poor trade location. So this B-shaped profile, lowercase b, of course, right here, is indicative of liquidation break because the A period suggests that it was a very quick and rapid descent off of the open. The first 30-minute period, B overlaps a little bit, the first hour of the session, and then really the sellers didn't continue to press the bet lower. Sure, there was participation down here. That's where value and the point of control ended up closing, but it's not like the market actually developed a trend day on that Friday session. A couple of poor references on the upside as well still persist. We have an extremely poor high on Wednesday. We also have a lack of material excess on Tuesday. What else is going on here? I would say that the Tuesday high is mechanical to the bottom end of value area low from Monday. So you've got some references to the top side that could use some repair. To the downside, at the bottom end of the Friday auction, you can see that there's plenty of excess in I period here. If I just zoom in, this is meaningful excess. This is the complete auction at the low end. So if we need to repair some of those upper references, that is definitely something to carry forward here from the market profile. The one bearish indication that I suppose would be irresponsible to at least not call out is that through the week session, obviously the value area did progress lower. There's Monday, here's Tuesday, Wednesday was overlapping, and Friday, of course, was clean to the downside here. We really treat this, the holiday futures session, as complete overnight activity. I would not reference that as a major market profile nuance, and for the most part, value slightly lower on Friday relative to the balance that we have overhead from Monday, Tuesday, Wednesday. Let's jump on over to the QQQ, nasty NASDAQ, and see what's going on with the Qs, weekly time scale. What do we have taking place up here? So it's going to be very similar in terms of the candle structure. We, of course, have ourselves a bearish inverted hammer, red-bodied bar, meaning that the close is under the opening print. Sellers made progress there. We have on the bar-to-bar count a lower high as well as a lower low, but notice that we've closed right back inside of the previous week's range after breaching the previous week's low. So not quite as bearish here on the QQQ NASDAQ, and clearly, if we were to do something that looks like this, it's really a two and a half-ish week balance range. If you want to consider this upper wick, a failed attempt to move higher, just notice that we're still over the original range, which was set from the green-bodied bar back here. So not as bearish in the QQQ higher time frames. I would make all the same references that we have lows, higher lows. This is a soft higher low. We could pull back. We could close the China gap. We could go all the way back down closer to about 492, 493, and still be offering a higher low on the weekly time scale. In the short term, I would really maintain more of a neutral stance until we actually take out the top end of this green bar from back here, in which case, fine. Maybe we target the bottom end of the range, but we have not broken down yet, right? I would not front run this idea in the QQQ NASDAQ. Let's take a look through the lens of our weekly anchored view apps on the Qs above the entirety of the stack. Once again, going to offer really firm support there if the weekly chart pulls back towards the top end of the China gap closure. If we come in here with, let's go volume profile, as we know that this is much more of just one high volume node. Where did we land relative to, yeah, it's not even a question, not even in play. Certainly higher low there. We're well above this. That's a little bit more centered in the 2-week balance range there. And did we back away from this high volume node? We closed right on it. So the highest volume node up here is basically the close of the weekly bar. Once again, I think there's more reasons to believe that we're neutral on the QQQ as opposed to bearish. I know it's not going to be much of a shocker, but if we quickly come in for the sake of congruency with the fibs from the low to high, you're over the fib 38.2, and from the top to the bottom over the fib 61.8. Once again, super support down here. If the market were to pull back like this, a weekly higher low in the zone is incredibly interesting to me. If we can see it happen, great, we'll look to participate, but as of right now, there's no reason to front run this idea and really start loading shorts until we're underneath, I would say at minimum, the top end of this green body bar from here. Let's drop it down to the daily time scale. Let's talk about the weekly expected move for the QQQ NASDAQ. What do we want to do here? We want to zoom in. There we go. And let's make this nice and clean for the eyeballs as well. There we go, looking pretty good. So expected move is here in gray. As always, the upper edge is at 538.54, implying a slightly higher high, very similar to the S&Ps. And here, sort of equal lows to what we had at the bottom end of the balance there at 515.12. Once again, a little bit more neutral on the weekly expected move here. It's not outright bullish. It would be much more bullish if, let's say, we closed here and the expected move was like this, right? So for the most part, the NASDAQ has not broken its key level, and we just saw that on the weekly time scale anyways. But look at this balance range right here. I mean, honestly, there's balance everywhere in the QQQ NASDAQ. You can see this balance range here, and you can see this balance range here. I would say as the market sort of flip-flops around between these two, there's honestly not very much in terms of a lucrative trade unfolding in the NASDAQ. And this is another reason to be a little bit cautious of getting overly aggressive on the bear side in the S&P. If the NASDAQ's not trading in its lower balance range, even if the S&P is going look above and fail on the weekly time scale, I just don't think it's appropriate to press the bet, noting that the tech sector is like over 30% of the S&P these days. It's going to be very difficult for the S&P 500 to move substantially lower if the NASDAQ is just chopping around in the range here. The S&P is much more likely to be sideways as well, or if you're trying to force downside trades, they're just not going to be, quote, easier trades. Remember that trading exists on a spectrum. We have easier trades on the left, and we have more difficult trades over here on the right. When the QQQ and the S&P are moving in tandem, easier. If they're divergent, much more difficult to actually have a stress-free style trade on your hands, right? So looking at the candle structure here, the one thing I would call out as of the Friday close is we do have a bearish engulfing bar on the QQQ. We completely engulf the range of the Thursday session. So it is possible that bears have a little bit of that edge here, but once again, I would just come into the weekly view and say, okay, if the bears do have the edge, and they did technically breach underneath the low of last Friday's session, why was there no close underneath 526.25? Why is that starting to act supportive? Well, if we just like think back to ourselves and snap out of it for a second, well, the reason it's being supportive is because the daily trend is still in the upward direction. Yes, it's been a really sloppy, ugly, annoying balance range up here, but don't forget that the daily trend is absolutely up, and we're only mildly pulling back from, via time mostly, the highest high of this trend count. So is it reasonable that a known area of previous resistance, which acted as support here, is going to act as support again? Again, let's snap out of the bearish rhetoric for just a second and think back to ourselves. Yeah, the daily trend is up. Of course, 526.25 could act as support. Now, if we get below 526.25, I think that the short trade is like that ship has almost sailed. If you listened to the Wednesday afternoon update, right, we were really interested, or I'll speak for myself, I was particularly interested in the fact that these thin structure moves could be retraced in theory fairly easily. And once again, if we just look at what happened on that Friday session, you broke underneath, you had thin structure off to the left. Did you get that nice, easy, clean, thin structure retracement? Absolutely not. And instead, the market just sort of balanced off towards the low end of what I would consider just the upper balance range here. So are we really aggressively changing our tone to bearish? No. Absolutely not. I think that there's a little bit more pressure in the S&P. There's a logical reason as to why, with the weekly close underneath the previous week's low, with the look above and fail on the 3-week balance range. But in the NASDAQ, it's not even close. The sellers just, really ran out of bullets, so to speak, here. Now, I'll still make the same argument. On the Friday open, the best thing that the buyers could have seen was just, some kind of rally over 533, Brigade bolt to the upside, and great, we're back to trending in the upward direction. We certainly didn't get that. We also didn't get support over the Tuesday, Wednesday lows. You can see the consolidation is underneath. But once again, the close is over 526.25. So the main idea here on the QQQ hourly chart from my perspective is I would be totally uninterested in an open in here, in between 528.35, 526.25. I'd be mostly interested in a open that starts inside, Brigade bolts above. That's thin structure retracement. That's simple balance range trading, right? This is like textbook trading 101 for a balance range. You try to buy the lows and you try to sell the highs. So if this is supportive and we don't really see a major reason for strong sellers stepping up at the bottom end of the range, then great. Your risk reward technically looks like this, back up towards the highs, right? So that's kind of a first thought there. If we and the way that I would trade that is likely on some sort of Brigade bolt here, if I'm being honest, over the 528.35. If we start to see, and maybe from a pattern perspective, if we do something that looks like this, it starts to build out inverted head and shoulders for those who like patterns. If we start to see acceptance below and we never really break over the 528.35, Brigade bolts here, you could try to take another stab at this thin structure retracement and maybe it unfolds, but we've seen evidence once and then twice into the afternoon that sellers were really unwilling to press the bet into that 526.25 or under, I should say. One caveat might just be, if we're thinking through this logically and maybe market mechanic wise, it was the day after a holiday. It was OPEX. It was a quad/triple witching, however you like to classify that. Is it reasonable that the market maybe got a little bit of a pin into the afternoon? For sure. So if we see stronger sellers step up on the Monday open, we'll know so based on the market internals. We talked about it in the S&P already here. This is the NYSE internals. But if you go over to the NASDAQ, we'll see this much more bearish. than what we had on that Friday session. So Friday, absolutely, volume flows were a little bit more firmly out of the market, but not breaching negative 400 million. The breadth ratio intraday never really substantially accelerated below a negative like mild 1.5. There was like negative 2 at certain points during the session, but really not Armageddon style selling. The advanced decline line on Friday never really made it to trend lower zone. The tick was completely flat out of the NASDAQ. So if the market is like, going to put all of this sort of OPEX in the rearview mirror, if it's going to put the holiday session in the rearview mirror, if this is going to yield considerable acceleration to the downside, we'll see it market internals wise. I would say that primarily the thing you would want to watch is your tick. On Friday, the tick opened well over the zero line, up over 1,000 even. If the tick opens on Monday under zero or even, down here at negative 1,000, then fine. Maybe there's some bearish momentum, but we just did not see that at all on the Friday session. So momentum would have to clearly shift at the exchange level if I'm going to take this as an active short to get here. At 522.50, I would also reevaluate. Why? Because it's the top end of this balance range, right? If you get this short, fine, but then this starts to become more compelling for, once again, a daily higher low. Let's not lose sight of that major daily trend that's still technically in force in the upward direction. So that's what we've got on the NASDAQ. I could quickly go back to the hourly and throw on the intraday anchored VWAPs just so we can see that. We are still rejecting the high anchored VWAP here. The Friday open could not sustain above. This is acting as support. And you can see once again at 522.50, reason to believe that there's some potential support there from the low end anchored VWAP. If we come in with the Fibonacci's from the bottom end of the move here up to the top end of the move, you've got your Fib 38.2 kind of slammed in between the two key areas, but lo and behold, it actually is the low of the Friday session. So long as that holds, it's really just nothing more than bull flag consolidation up here towards the highs, and ultimately seeking the equal high would be the correct target if that's going to persist. Let's take that off. Let's take a look over at the market profile for the NQ just to see if there are any nuances we should be picking up on. Let's make sure we can see it all. I would think that this week is almost a complete washout. Why? P-shaped profile, short squeeze to the upside on Monday, and then B-shaped profile, liquidation break. It's the opposite of a short squeeze on the Friday session. Same concept as what we talked about over in the ES. There's really not much to talk about here. You have value that's migrating slightly lower, and we will, of course, call that out. Friday was clean to the downside with a point of control migration, but you do just have liquidation break. Seems to me poorly located longs continue to close out of positions. It's not really aggressive selling, right? This is not a trend day on that Friday. Let's go back on over to the platform. Let's finish up the big three with, of course, none other than everybody's favorite little brother's cousin's third removed second aunt's brother, sister? One of the two. It's the IWM. It's Russell 2000. It's the small caps. What do we see over here? Let's go up to a weekly time frame chart. Let's go ahead and clean up the drawing set here, and let's see what we can see. The big bad level that we know we care about is really down here, closer to the 200. If I just grab more than 3 years, it's crazy that it's been, so long already, actually. But if I grab more than 3 years, you can kind of see back to here, doing something like this. There you go. Much more clarity. So we're continuing to spend time on the weekly time scale, at least, over the 200 figure, over the weekly 200 SMA. But we really don't have what I would say a clean-looking sustained breakout of, as we know, the inverted head and shoulders, right? We'll see it more clearly on the daily chart in just a second as well, but this is kind of your breakout neckline right there. The weekly chart's closed right on it. It's a little bit of an indecisive doji. The only bullish comment I would make is if we just think back to our roots, what do we see in terms of candle structure and location? We've got a little bit of a doji. It's a little bit more indecisive than the other two indices. Didn't close square on the lows. Still closed in the lower 50% of the range, but it did look underneath the previous week's low and close inside the previous week's range. It's undoubtedly a lower high. So I think that it's still primarily bearish on the bar-to-bar count here. However, it's not as bad as it could have possibly been. I think that the Russell is more so in a wait-and-see mode than anything else. If we're thinking about the trend count, we still have lows, higher lows. This could be a higher low. We did get a little bit of a daily downtrend there. You can see that it did close the China gap. It tested the weekly 200 again. So I still think that we could set some sort of weekly higher low. We're just not cleanly getting continuation out of what I would consider this chop and slop, because as we know also, there's kind of a nuanced hourly inverted head and shoulders there as well. From a Fibonacci and anchored VWAP perspective, there's a lot more work that needs to be done out of small caps. You're just kind of hugging the cluster of anchored VWAPs here. If I just zoom out, remember this is the previous all-time high and the lowest low anchored VWAP there. So you're staying over the stack, which is, I suppose, a slightly more bullish thing, but you still really haven't negated this downtrend here. You have this lower high. I would still absolutely argue that this to this is a higher high. What do we see from a Fibonacci perspective? Really quickly coming in from the top down to the bottom. Still rejecting that Fib 68.1, so decreasing or just not it's not decreasing the odds, but the odds are not elevated for some sort of massive 100% retracement because we have not yet recaptured that golden fib. If we come in from this lower high to here, we're just kind of hovering over the fib 68.1. So I like that it's somewhat supportive. It's also confluence with the top end anchored view app from back over here. So we've got that going for it. If we take a look from the bottom end up to the top end, we're still well above the fib 38.2. So hypothetically, like I said, it's not as bad as it could possibly be, but it's just not, we're not getting follow through out of small caps, which honestly, I think some degree of that is maybe due to Powell and the lack of clarity around rate cuts that I think the market was sort of hoping for, even from the updated SEP on that Wednesday session. Let's clean this up and let's go to, where do we want to go? Let's go to a daily time scale here for our small caps and see what's going on. We really want to keep it simple. There's one little zone, right? It's a balance range that we care about. So here again is the inverted head and shoulders. Your neckline was back here. This week, we really just chopped right back through it. So you've got a 5-day balance range here. And again, very simple. Don't overcomplicate small caps. Inside the range, I would maintain a neutral to bullish stance because of the higher time frame weekly. If we Brigade bolt out of 211.25, great. Ultimately, we're looking back to the daily 200 SMA. That would be bullish. If we Brigade bolt underneath the 208.50, that's where things get a little bit more dangerous from a failed breakout perspective on the inverted head and shoulders neckline, which we just identified, of course, as 209.75. So really just keeping an eye on that balance range. Once again, to reinforce, here's your nuanced, even smaller inverted head and shoulders. The neckline is still the same exact level. Let's take a look at the hourly time scale and see what else we can glean. Really not much. The only difference here that I would call out is that on the Friday session, the market did not make any substantial lower low underneath the Tuesday and Wednesday lows in the IWM. So the bearish consolidation was certainly towards the lows of the session. If we take a look at the internals for the Russell, we'll see them very flat here. And I would just sort of reinforce all the same points. Although, yes, the consolidation was towards the lows, it really wasn't that bearish at the exchange level. If we take a look at the market profile and just jump back over here on the Rusty, you can just really start to see. Let me actually close up this split profile from back here, remove splits and merges. There you go. I mean, value from Monday, Monday would have been here, from Friday, which really kicks off the 5-day balance we've been talking about anyhow, contains value from Friday. If I do something that looks like this, right? There you go. So is the Russell really doing anything? No, it's not doing anything whatsoever. So in my view, I would say on Friday, if the buyers were going to make something a little bit more substantial happen, they should have materialized, or I should say capitalized, on this higher open and maybe built out value over the top end of the box. It just didn't happen. Really didn't happen. So I think it's a wait and see game here on the Rusty Russell. There's not much to really get into other than just watch your classic balance rules inside of this range. And, look at your anchored view apps. They're also agreeing. No need to jump the gun unless you're outside the box. 211.25 and 208.50. With that, I think we can jump on into our S&P sectors. We've got a little bit of a more expedited weekend video, it seems like. I'm not sure what the timer looks like right now. But anyways, what do we see out of the S&P sectors? Who was leading, who was losing, and where was the weight? Well, leading the pack is energy. That's slightly more defensive. It's really not even defensive. It's just a lightweight sector. Technically, when energy outperforms anyways, it's a little more inflationary and the market tends to come in. Energy and interest rates kind of have a small correlation, right? If you look at TLT bonds, technically outperforming on the week as well, that's definitely a little bit more defensive there. No major outperformance, though, and we'll see that on the technical chart in a second. Semiconductors are actually up on the week, up about 12 basis points, and then financials pretty flat, but still green, up about 8 basis points. At the bottom end of the barrel, it is the XLV, so healthcare is absolutely more deeper defensive. It's no longer in the top 4 heavyweight sectors. It actually got bumped to weight number 5, considering that discretionary has kicked it out. Consumer discretionary has kicked it out, as has, communications. Communications is also up there now in the top 4. Materials are a really lightweight sector. Not much to comment on there. There's discretionary, speaking of the devil, down about 1.28%. And then utilities. Everything else was sort of underperforming in terms of, outperforming in terms of the S&P. The S&P is down about 1.02% on the week. So posture here does not strike me as alarming, like, oh my God, let's run and duck and cover. Semiconductors are still outperforming as the market mildly pulls back. We have a little bit of underperformance from, not even underperformance. Again, you have to think about this in the inverse. When the S&P is down 1%, XLK is mostly unchanged. That's a little bit of outperformance. The underperformers are defensive, right? Healthcare, discretionary is the one concern. So I really don't see this as, posture-wise, a large issue for the market. If we just rip through some of these charts, energy, although it's higher, it's not aggressively trending higher. It's also not pushing the S&P to brand new all-time highs. So as energy is green, it's fine when the market pulls back, honestly. That would indicate some aspect of a rotational market as opposed to a market being led by all the wrong things, right? If the S&P 500 was ripping to brand new all-time highs and energy was breaking out and closing this gap, and that's what was causing the upside, yeah, that's a red flag. But do we have that as a situation right now? The answer is no. If you look at the TLT, once again, is this outperforming in a massive way? No, it's been range bound in this box for a long, long time. Honestly, on the FOMC, there was hardly any volatility. It doesn't strike me as an issue there. If you look at the semiconductors, it's range bound, but look at the location of this range. Look at that. Is that bearish? Absolutely not. Look at the top end of this previous balance acting as support on the Friday session. On Friday, breaching underneath the 3-day balance range lows, not finding any follow through from the sellers. If we're over 258.75, how could you be bearish in the semiconductors? Right? If it's going to be distribution, you've really got to clear this previous low. You've got to at least get a daily close under the 258.75, then start looking for the pullback to the top end of this box here at 249. We didn't even get that on Friday. It's much more neutral waiting, in theory, for some sort of bull flag breakout as the next step up and over 264.75, looking for upside targets. So that looks bullish to me. If I look at financials, this is a sore spot for the market. I think you've got to parse this out very explicitly and say that MasterCard as well as Visa are causing all of the downside. If you look at the banks, per se, we'll just say B for banks, the banks are holding up actually fantastic. JP Morgan looks good, Morgan Stanley, Goldman Sachs, the big banks are doing fine. So I find it interesting that these two are providing all of the drag, of course, with the stable coins and the Genius Act and all that. But you can see that we just have inside bars here. In theory, if this is going to act as a double top and some sort of reversal, just understand that you need to be underneath that 49.75. We haven't really done it yet, but these upper wicks rejecting this overhead supply seems a little bit more cautionary, a little bit more bearish than maybe what we're talking about over in semiconductors so far. So keep an eye on the XLF this week. If it starts breaking down, that might be a larger tell that we can, maybe a little bit more bearish in the S&P, right? If we look at healthcare, what's going on over here, a bit of a pullback from the midpoint of the range. I really think that healthcare needs to break the box. Like before we say anything constructive about, healthcare is really acting as a big boon for the S&P, or oh my God, it's the largest drag I've ever seen. You've got to get out of the box. Healthcare has really failed to do that ever since this volatility back around tariff time. Let's take a look at materials. A little bit of a pullback into the lower range here. It is pulling back off of the daily 200. It is pulling back from the highest high. Theoretically, you could get a weekly high or low here. I'd be a little bit more neutral now on materials under the 87.60 and in between 85. I'm going to look at the XHB for home builders here real quick and just call out. Remember, we have some tension here on the home builders, right? You could either say that this is a double top and you got to break the neckline here, or my view might sort of be, if this is a weekly double bottom, and you can't call either of them until you actually crack the neckline. Notice that we've closed above and below both necklines. But if it's going to be a little bit more constructive, if the market's going to pull out of this and we're going to achieve the quote soft landing that everybody's so hopeful about, I would think that the home builders need to crack up and over the $100.50 mark, just because it really doesn't. It does not act too divergent from the broad market for a sustained period of time unless there's a larger issue. You got to think about home builders as the ultimate sort of signal, if you will, of the cyclical nature of the market, right? All of the different components that home building ultimately implies. So I'm watching that very closely. We do have a lower wick, now that we've zoomed out to the weekly time scale, we can see this a little bit more clearly. Looks underneath previous week's low, closes back inside previous week's range. That's impressive considering the larger upper wick from the previous week. So we shall see. My preference is that this resolves this way and we're kind of in the clear for the market. But again, we have to take this in stride. Whatever the market does, the market does. We might want something, but we have to trade the chart in front of us until we're over that neckline. I would not make an aggressive bullish call just yet. Let's move along into our sectors again. XLY. We're on the weeklies. The weekly actually is fine for the XLY because you can see it very clearly. There's your balance range. There's nothing to do here until we start cracking into the balance. Out of the balance into the China gap, or if we break above this previous neckline of the double top from back over here, right? On the daily time scale, you can see it much more clearly. Daily 200 is creeping up, providing support there. So if we're over 208.75, I just would not maintain a more bearish stance. Just wouldn't do it. There you go. Sideways in range. As a matter of fact, towards the bottom end, just like we were talking about in the market, right? You want to take your classic technical analysis 101 rules and say, here's your area of support. Here is your area of resistance up here. Let me grab the red crayon. There we go. What do we want to do at support? Let's see if we can find longs. Risk, reward, back to the top end of the range. If we break below, maybe gap fill reversal. something that looks like this, right? We'll see. But for now, I wouldn't front run the idea that, oh my goodness, XLY is going to fall off of a cliff and just go to zero. Let's continue along. Let's take a look at utilities. Still retesting the top end of the range here. Really nothing big to talk about on this chart. Industrials, mild drift to the downside. It looks fine. Again, little rejection of the all-time high. We talked about that on Wednesday. I would not be an aggressive bear here. I just wouldn't be. It seems to me more neutral in this range as opposed to anything else. If we start to use all of this as overhead supply like that, fine, cause for concern, but we're just not even close to having that conversation yet. If you look at communications, a little bit of an underperformer here with that big bearish engulfing bar on the Friday session in particular, but where are we? We're still over previous areas of resistance that can still act as support. I would only be bearish communications should we breach underneath 102.25. Real estate, nothing to talk about, sideways in range. Let's talk about staples. Oh, there's nothing to talk about here either, sideways in range. And what about the tech sector? Really more balanced up here towards the highs. It still looks bullish well above this previous top, so 235.75. Even if the market were to break this little flag range it's building out, I would be looking for support here, see if we can find buyers hook back to the high, and ultimately go on to make more higher highs, considering tech is definitely in an uptrend. It is the heaviest weight risk on sector. Let's see if we can persist here. Really no cause for concern until we're underneath 235.75. Could it happen this week? Sure. Anything can always happen at any point in the market, but in terms of odds, in terms of playing the probabilities game, if we're above that level, I would maintain more of the bullish stance. Let's move into our sector ratios in terms of risk on, risk off, just to get a sense for risk appetite out there. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner on how to set up ratio charts. This still looks risk on. This has some work to do. This looks like it should no longer be here, and instead communications is going to take that slot. Generally, this looks a little bit better. XLF financials, trying to carve out a little bit of a low here, but I would not say that this is a compelling uptrend. I unfortunately have to give that an X. So really, it's a one risk on. This is kind of, I would even count this as a little bit more neutral. Notice that it's still not outside of this swing high and swing low. So really neutral with maybe a small risk on edge here. I would not call it risk off. You're not seeing great outperformance from staples, nor are you seeing it from utilities down here either. We can reinforce that view as well if we use some other watches. You can see that this still looks risk on. This looks risk on. Everything here is in an uptrend. This is a little bit, I'm going to go check/neutral out of staples and discretionary. This, though, absolutely is just ripping to the upside. ARK-K, the innovation ETF, is just off to the races there. If you look at the broader measure of Russell 2000 growth versus value, still looks okay here in an overall uptrend, getting a little bit of consolidation. We know that momentum has slowed down. I think you'd be a fool to not recognize that in the market context right now, and I think it's been very clear through the charts we've looked at. So as some of these balance off and go sideways, I think it's fine, but overall the trends remain in the upward direction. We don't have massive trend reversals on the risk on-off charts. We can do the same thing over here on the B set, which of course has gold in the top left, gold relative to the S&Ps. Kind of more neutral than anything else. If we were seeing flight to safety like we were during the tariff time, this would be going parabolic again, trying to make a reach for these highs here. Not the case. As we look at Bitcoin, Bitcoin is a little funky. You've seen a little bit of like some upside, some downside. It's not really getting much in terms of the participation from the Genius Act stuff and some of the regulation headlines that have been going on out there. So we actually did start to breach the previous week's low. Now that we have a bearish signal here on the Sailor Shift tool, is it possible we get some breakdown into that 92.5? Does seem possible if this is going to act as overhead supply, but once again, what's the major idea at 92.5? Can we set the next higher low on Bitcoin? So I'd be watching out for that when we approach it. If we flip the Sailor Shift tool back to green, I would start thinking about longs off of that level, possibly looking for some Bitcoin swing trades. Never been fond of shorting Bitcoin. Is it lucrative? I'm sure some people are making a killing on it, but for me, I'd rather just wait and see if we can add to longs here at that 92.5. So pretty clean out of that chart. If we look at the TLT ratio to the S&P, no major outperformance from the bonds. Again, still slammed down here towards the lows underneath a massively descending 50 SMA, kind of a non-issue from the TLT. Let's jump into our dollar and interest rates, get a little bit more fundamental. The dollar kind of went sideways on the Friday session. Excuse me. If it's going to still be supportive over this 97.75, remember that the 101 retest technically would be bearish for equities. The dollar has a little bit of a negative correlation right now with equities, so we'll watch out for that. Interest rates backed off on the Friday session, really still stuck sideways in this range. We saw that on the TLT chart. Anyhow, if interest rates come down a little bit, I would tend to think that the dollar might struggle to get to the 101 easily. And obviously, we've seen a Fed that is kind of sideways about, are they going to wait? Are they going to look for this massive inflation? They seem, at least Powell, in terms of his press conference on Wednesday, seem to be very concerned about resurgent inflation. So we shall see what the reports hold for us. But for now, it's not showing up in the actual numbers. Here's the inverted ZT doing nothing. It's completely sideways, which means that the Fed is very likely to pause in the next meeting. That doesn't tell us anything we didn't already know. Let's take a look. Let's just actually go over to the Fed tracker tool. Speaking of now, there you go. About 89.7% odds of the pause. But remember, what we really care about here is how many rate cuts are we scheduled for into the end of 2025. The market's still looking for 2. 1 and 2 here. That may or may not be a good idea considering what we learned in the S&P. If you take a look at the S&P, these median projections are what were just revised and what the market really cares about. You can see GDP, and we've covered this a couple of times on the channel, so I appreciate you sticking with us if you've already heard this. But revision down to GDP, up to the unemployment rate, and PCE inflation also up from a 2.7 to a 3.0. The Fed funds rate remains stable at a 3.9, but if you dig deeper through the actual report here, and zoom down to the dot plot, the infamous dot plot, there it is. What you'll notice is a pretty, split Fed with a majority, obviously the majority is sitting there at the 3.9, but look at where the next majority is. It's actually unchanged around a 4.4. So, I mean, if any little uptick in inflation starts to come up, you might actually go all the way back down to 0 rate cuts into the end of 2025. Should we start seeing some hot reports from the CPI and PPI, most importantly, the PCE is really just an amalgamation of the two. So I think that this is the most important takeaway of the Fed. The Fed is sort of split almost right down the middle between 0 cuts and maybe 1.5 cuts. So that is that. The other important thing to make note of in this document, if we scroll down, thanks for bearing with us once again, we want to look for this. The risks to the unemployment rate have been dropped, but are still weighted to the upside. And you see the same thing down here. If we look at the risks to inflation, they're still weighted to the upside, but they are lower than they were previously. Because those two things moved in the same directional vector, they both moved down, but are still weighted to the upside. The Fed really didn't give any sneaky signals as to whether or not they're thinking about, hey, the labor market's deteriorating and we have to pay attention to that side of the dual mandate. They would have shifted these odds more meaningfully to broadly balanced, and that would have been your sign to say, okay, the Fed is going to cut rates most likely about 2 times into the end of the year. We just didn't see that. So the FOMC meeting was really a nothing burger based on the updated SEP. I would say quite firmly that this actually is an instance of Jerome Powell saying, hey, let's wait and see. Let's wait and see. So speaking of fundamentals, what do we have next week? Really not much outside of the PMIs. These are the S&P flash numbers. These are the most meaningful for the market. So about 15 minutes into the session on Monday, be prepared for a little bit of volatility. We'll, of course, remind you of that in the pre-market prep, which, as always, will kick off at the 8 o'clock time frame on Monday morning. We're live every morning at 8 here on the channel. A lot of Fed speak this week. Excuse me. And then we get Powell testimony later on Tuesday, 10 o'clock, as well as Wednesday. This is the semi-annual report or testimony on monetary policy. You're really not going to learn anything from Powell. He's going to get peppered with a bunch of political questions when everybody tries to take their stab and make their name known in the interrogation, so to speak. And it's just going to be a nothing. It's going to be a nothing burger. It's going to be a lot of political showboating for all the people in Washington. What else do we have here? GDP quarter-over-quarter numbers. Jobless claims on Thursday, the usual, more Fed speak here, and PCE on Friday is probably going to be a nothing burger because the market already knows the CPI and PPI print. So I'd say the biggest deal is going to be your flash PMI numbers up here, manufacturing and services. We'll watch to see how those come out. That's going to be early week data. Beyond that, it's really nothing. Unless Powell lets something slip on the 10 o'clock time frame and you're watching that, I would not trade around, What's the bottom line here? I would not be so timid to trade around Powell's testimony. I think that the market's going to listen to the opening remarks as he says, like, thanks for having us here, and, like, this is kind of where we're at. I think the market might get a little flashy around that, but once the market settles into, okay, just a bunch of political back and forth nonsense, market's not going to care. So I wouldn't be overly cautious of that time frame. Let's jump into our earnings calendar here. Not much to talk about. FedEx generally has some decent commentary about the state of the economy. We might watch out for that. Micron will be interesting on the semiconductor side. Nike, maybe on the tariff side, see if they have any developments based on what's been going on over there. That's really it. Pretty quiet. We're towards the very back half of the earnings season, and we'll look for the next cycle to really kick off mid to late July, I believe, with our financial institutions. JP Morgan is typically one of the first big banks that kicks it off. Let's get back on over to the platform. Let's finish up the look through some of our additional data points. Bonds relative to themselves. I think that this is exactly what we just talked about on the SEP document. This did not budge. This did not budge. If the market was much more concerned about inflation, then this actually would have seen an uptick. If the market was like, wow, Jerome Powell, you have to cut rates, the labor market's going to implode, this would have been lower, and you just didn't see that. So as of right now, I do not believe that this is telling us anything of note, honestly. Let's jump into credit spreads. Credit spreads mildly lower on the shorter term, more medium term, a little bit more sideways. Still nothing major. I think that the risk appetite is fine for equities based on that. If you look at the junk bonds in isolation, this is honestly, when I was saying in the intro, if you look deeper than just price, there's honestly not a big reason to be bearish. You've got a bullish divergence. It's very subtle, but it is bullish nonetheless here out of HYG. If you look at the LQD, it's a little bit more on par with what we had in the S&P down here. So, certainly would want to respect that. There's sort of push-pull, corporate grade versus junk. But you got to think of junk, right? What do the junk bonds represent? Like in the bond market, that's the riskiest type of bond that you could get into. So positive divergence there would still speak favorably, I would think, towards the risk appetite of equities as well. If we jump into the total breadth of the market here and zoom in, let's actually go to a daily chart here. 3-month daily chart, a little bit of an uptick on the 50 SMA out of Friday, downtick on Friday, mild downtick on new highs versus lows, but still positive. So any alarming issues with the breadth of the market? Not really. We know that we're on a pullback. If we take a look at the RSP, what you'll see is very similar. You're inside this consolidation range. If it was breaking the lows, that'd be much more of a red flag. It's just simply not. We could jump straight to volatility because breadth, again, there's nothing to really talk about there. VIX, stable, sideways. Honestly, I think that with everything happening in the Middle East, you'll remain elevated here on the VIX for a little while until there's a firmer resolution of that. And I think that that is completely fine for equities. I don't think that it's a major issue for equities. And, you might say something like, okay, the VVIX as well is fairly, it's technically elevated, that 103 level. If it's not breaking out and doing something substantial, if it's not really rallying aggressively, I don't think it's worth being an alarmist out of volatility here, especially noting that the volatility futures are still technically in a contango. If you look at this chart here, it's not a very wide one based on what you can see down here at the very, very back contracts, but the front contract, contango. Next one, contango, narrowing up a little bit. And yeah, it would be best if this was cleanly trending in the upward direction, but it's not at a point where, oh my God, the backwardation is so severe that money managers are completely stopping allocation to equities right now. If we just go back to this, you can see that the one-day VIX did open lower on that Friday session, which was to be anticipated post FOMC. Now it's just a matter of, okay, does it continue to drift lower and spend more time underneath that 1275? So volatility here, a non-issue for the market. I would think... what would it take? It would take some sort of reignition of trade war fears. It would take some reignition of like new threats of nuclear war over the weekend to possibly ignite the VIX here, but I'm not in the business of speculating on that in particular. So if you're an energy expert, speaking of energy, let's maybe just take a look at the CL. I think that the takeaway here is, as this remained elevated, and here's the unaffected price considering the Middle East conflict, as it remains elevated, I think the market's still pricing in some degree of uncertainty and risk as to how that resolves, but the fact that it's not continuing to rip in the upward direction would just indicate that market participants are not seeing, there's not like complete and total destruction, and I should be careful. Obviously, in certain parts there, I'm not trying to omit that, but generally to the oil supply is what I would think, right? So some of those key shipping routes aren't being closed, right? There was that big threat. You're just not seeing it. So oil, it's like kind of on edge, but the fact that it's not continuing to move higher, I think is saying like, okay, unless there's a new headline that yes, nuclear war is imminent, oil is just not, it's not going to budge, right? So we're all set on that. Let's continue along back to the core list of companies here. And let's take a look. NVIDIA was, we got a little bit of that headline news on the Friday session about the, restrictions back to the China exports, something along those lines. Big move lower here is ultimately just a move back down into the balance range. Now that we've got two attempted breakouts over the 146 handle back here, you can see this and this. It starts to look a little bit more like maybe the S&P, right? Where you've got a look above and fail on the range. Any sustained lower highs now under 145 should target the bottom end of the range at 140.50. Do I want to be aggressively bearish here? Probably not aggressively bearish. I would think that if this, and here's another reason to not be aggressively bearish. If you do this, you have a 3-day balance range here instead of a 3-week. It's a 3-day. On the Friday session, you looked underneath that low at 143.25 and closed back inside. So this consolidation, if we were to get back here and do this, I would probably start participating alongside on NVIDIA up and over these equal highs at 146. You can see it as clear as day on the hourly time scale, right? Where, stronger sellers, if they were really going to make it happen, if it was going to be game over on that Friday session, this is really what you wanted into the close. Didn't happen. So if the market consolidates here, I'd still maintain a little bit more of a bearish stance. I'd say, okay, we're getting a little bit better back over 145, and then I'd really start to participate, look for active trades over that 146 in the upward direction. Let's take a look at Microsoft. Very similar. Let's not even go to the daily, right? Why go to the daily when we can just look at the hourly and say, okay, there's your look above and fail on a 1, 2, 3, 4, 5-ish day balance range. You've got a 5-day balance, failed the gap up on the Friday session. In theory, the best outcome would have been this. Hold above the top end of the range, successful breakout to blue sky territories. Obviously not the case. So lower highs under 479.75 that then breach 477.75 probably look to the bottom end of the balance, right? And then once again, like we've been saying on many other charts in today's episode, when and if we get down there, is it possible to get some sort of range rotation, risk reward back to the upside? Perhaps. Really depends on what the broad market is doing at that point and whether or not we've maintained a daily higher low in the S&P and the NASDAQ. Let's take a look at Apple. This is not the apple of our eye anymore. It is just it's still the third heaviest weight company, right, in the S&P 500. And for those who are unfamiliar, right, this is a great tool. If you don't use the fundamentals tab on the Analyze, so fundamental sub-tab on Analyze, it'll tell you your S&P sector weight right here. So when I was saying, oh, you know that healthcare got bumped down to 5, there you go. 9.49%. Communication services is now the fourth heaviest weight sector. But anyhow, the point we were trying to get towards is that Apple, although the chart absolutely sucks in terms of tradable action, it's still the third heaviest weight company in the S&P. We cannot ignore that. So where Apple goes, the market may go. And as of right now, it's just bottoming off the bottom end of the balance range here. So if this is going to help out, rotation towards the top end of the range should keep us bullish in the S&P. Let's move along to Amazon. Nancy, as we call her, the daily retest of this level at 206.50 is the key. If we could stay over that number, I think that we rotate back up to the high, and ultimately Amazon remains constructive for this kind of daily trend continuation, high or low, pulling back from the highest high. This is the next highest high. So the follow through would be starting to look through some of this thin structure, retargeting this and these, right? So Amazon still looks good to me. I mean, absolutely still a daily double top kind of happening here, but as long as it's over 206.50, the daily is fine. On the hourly time scale, the way I would trade this is perhaps, and here's a couple of permutations, if we open on Monday in range, an extension to the downside, and here, now you're dealing with inverted head and shoulders, look at the squeeze possibility through this thin structure over 210. Over 210, I like it. If you gap up over 210, it's not really a true gap, but if you're inside of range but opening over 210, I would think you have the possibility of a Stevie Wonder trade on Amazon early morning on Monday. You know, size the position based on total amount of risk you want in it. So if you're willing to risk, let's just say $100, then you buy $100 worth of options contracts. If you're wrong and they start to move against you, so calls in this case, then you probably don't let the $100 go to zero, but at least you're not like, oh my God, I couldn't control my loss, right? So Stevie Wonder trade here available over 210. If you open under 210, the inverted head and shoulders would be the preference, with Brigade Bolt over the neckline for that same idea. 214.50 thin structure retracement is the overhead target. If it is going to continue to the downside, right, then consolidation here that does this, and we start to Brigade Bolt under the 206.50, I would be not interested, really not interested in trading Amazon through what had been a very choppy range back here. Okay, so really not interested in those shorts. Let's move along to Google. Google with the double top action happening here. Larger breakdown and much more firm failure to hold over the 168.50s. If we take a look at the daily chart, note that the daily 50 is kind of looming down here, but ultimately there's much more overhead supply on something like Google than there is over on that Amazon chart. So for now, the sort of equal low on the daily time scale means that there's more of a threat to flip into a lower, a trend lower on Google's daily. So rally rejections of the 200 should start to bring out what? One of these. Now you have head and shoulders, and it gets just much more difficult to trade Google, I would say, back inside of this nonsense range from back here. So I was not very fond of Google's chart back here. I'm not the most fond of it, but if we need shorts, it does seem to be one of the weaker names in the market right now, and I would latch on to that. If we look at Metaverse, the daily chart still looks strong. Obviously, you could build the argument that this is starting to look a little bit like distribution, maybe a little bit like a double top. If you were to breach this neckline here around the 680-225s, thin structure retracement 661 starts to come into play. That would be a major spot where I would be looking for longs. Can we find daily hammers, risk, reward straight back to the equal high on the daily time scale? Here it is on the hourly. So there's your balance range. If this goes look below and fail, I would also look for longs here. Risk, reward, if the broad market is also getting a little bit of support, some buying action off of the pullback lows. So 680-225 top watch here out of the Metaverse. If it breaks down below it, once again, you could probably trade some shorts considering the overhead supply that you have on the hourly chart at least, but in this 661 zone, absolutely do not lose sight of that daily setup. That is a beautiful pullback that I would try to take advantage of for a daily higher low. DHL shipment. Let's move along to, I was going to say Netflix, but this is Tesla first. Tesla could not do anything on Friday. Sideways in the balance range. Patience. Over 334, starting to look for upside. Under 313.75, starting to look for downside. Not much to say outside of that. Look on the hourly chart. There's really not much to do inside the midpoint of that balance range. Remember that your edge literally exists at the edge of the range. Breakout or mean reversion, breakdown or mean reversion. Until we do one of those four things, I don't really think that I'd be all that interested in trading Tesla around that 323. Let's move along to JP Morgan. This was what I was talking about earlier with the banks looking good technically. You've got a little inside bar in the upper third of the range on Friday relative to the Wednesday range. So inside bar breakout over the two equal highs is looking at blue sky territory. Looks pretty darn good to me. There's your earnings coming up midway through the July month. If this does pull back a little bit more firmly, you're talking about 270 on JP Morgan looking for longs off of that level. So if this breaks, right, you have a thin structure retracement, then you have a daily higher low available here over the top end of this previous balance, right? So 270 and 277.50. Let's move along to Netflix. Not much to talk about here. If it's over the 1210, I would maintain the bullish stance. And again, it's avoiding this head and shoulders. If it's here, it's looking much more just like an upward trending channel. I don't know that it's really offering a new swing opportunity for longs. I would think that the swing opportunity was either here on the recapture or maybe on some of these breakouts over the 1228s, getting involved in longs down here. And now you're just sort of sitting in risk, reward, something like that, looking for the resolution. I don't know. Netflix has been, it's a very back burner idea for its actual intraday movement. Let's take a look at Palantir, graduating to our core list of companies. We love that. Let's take a look at the daily chart first because I want to talk about this structure off to our left and just continue to reinforce that if we're over this level, then in theory, this is a massive daily Brigade bolt. We should not lose sight of that higher time frame idea here on Palantir off the 133.50. If we go down to the hourly chart now, you could start to see how this maybe starts to emerge as head and shoulders. Break of this 137 gets us to that daily sweet spot at 133.50s. And again, we should not forget about that risk and reward back to the all-time high like that if we can spot buyers. Remember, we're not just layering limit orders here saying, oh, let's blindly buy Palantir. No, but if we can find an hourly trend reversal off of that, then great. The location makes sense for that higher low on the daily. If it is going to be constructive back to the upside, one of the things I was a little hopeful for on the Friday session was honestly that this was going to act as double bottom over the neckline, but we just got to be back over 140. Right at the top end of this little hourly box here. So over 140, I start to change my tone, seeking all-time highs. This is a pretty weak level around the 143.25. I would expect that to break, and the idea there might be like a quick intraday scalp just to the all-time high. I know it's a very small range to look for, but something like this, risk-reward to do that. If we could find it intraday, perhaps, and again, the idea is just that this is a very mechanical, very visual level prior to the all-time high. Let's move along to AVGO Broadcom, another one that's graduated to the core list of companies here. Starting to get a little bit better. I like that it flushed out this balance range low and, of course, closed back in the range on Friday. So the next big watch here, I would think, is acceptance back over 253.75 to target the gap close and then beyond the all-time high. If you take a look at the hourly time scale, you could start to see this, right? Stronger sellers ideally produce this, and that's still a possibility. Let's not get it twisted. It's still a possibility, but you could sort of, I don't want to get too level happy in here. You could put another level in there at, what would it be? 248.50s, really, 248.50s right around in here. If you're over that, if you're in here, I would start to be a little bit more constructive on this. If this is going to go double bottom over time, really, it's just targeting this to the all-time high. But the next idea, as I was saying, I'd be more interested in this. Here, risk and reward. That's kind of the next setup I see out of Broadcom if it's going to cooperate. If it's just noodling around in the range, not really doing much, we have to watch it because we have to watch that 253.75, but I wouldn't be active inside of this chop and slop off to the left. And once again, this is based on the premise that sellers flush the low and we're already starting to get acceptance back in the range. Persistent acceptance, in my view, would increase the odds that we go higher. If we just do one of these and we start consolidating here, that's a different story underneath that 249.75. All right, I've got a couple of additional trade ideas to share with you today. It's actually more than 3, it's 5, but I hate drawing 5, so in the intro we said 3. First is on WDAY. Workday. Let's go to a daily time scale here. The neckline retest is kind of in play, and I would think if this was going to be, a no-brainer, okay, back to, the local highs, whatever, it's bullish again, earnings would have bounced off of this and not looked back, right? But look at how we're already back down to it after setting ultimately a lower high in the daily trend count. Inside inverted hammer on the Friday session, we want to pay attention to the neckline of this double bottom back here, the tariff volatility stuff. If we're underneath 235.50, this thin structure candle can absolutely retrace. Here it is on the hourly chart. Look at this straight up move, right? That means, right, if we were to get under the 235.50, this trade here is probably lucrative as a day trade, some sort of large flush. I would probably want to pair this with a day where the broad market is also bearish if we're really going to look for that acceleration. That's way too much risk. There we go. Risk, reward, something along these lines, right? Here's your Brigade Bolt. Under 235.50, targets 228. Let's move along from Workday into Oracle. Not the Oracle of Omaha, but rather Larry Ellison, who I think is moving up the ranks post earnings in terms of net worth. Kudos to him. Let's see if we can get this pullback towards the 200 figure and retest this previous pivot high. If you look intraday, it's the exact pullback of the post earnings mild consolidation low. So 202 to about 198.25. I'd be looking for bullish reversals on the hourly chart in this zone, then trying to retarget the all-time high. So Oracle is still a top watch on this movement. Here you also have very equal highs up here, and that's sort of the improper end of the auction. So if we can support this, offer a daily high or low, then I would absolutely be thinking about, all right, let's go back to the high, let's trim a piece here, and then really hold out to see if we can get continuation into blue sky territory. This would be ideal if the broad market was also bullish, right? Let's take a look at MasterCard, one of the culprits from the financial sector weakness. If you take a look at the daily time scale, we've extended right into the daily 200 SMA, and we did print, after a small overshoot on Friday, a daily hammer. That means if we're over the Friday hammer high, we're looking for thin structure retracement, probably back into this low. Let's take a look in the hourly chart so we can see this. Yeah, look at this thing. So, in theory, this would start to look like if we open here, Brigade Bolt over the 538.75 starts to target this previous low around, let's call that 553. 553 for round number's sake would be our upside target. So, something along these lines, risk reward like that, thin structure retracement. So that's MasterCard, and you have the daily chart working in your favor as well, that support over the daily 200 SMA. But Matt, what about Visa? It's got to be the same setup, right? Well, you didn't really get as close to your daily 200 SMA. You do still have a similar hammer candle here, but I like the setup on MasterCard slightly better, just because of those nuances, right? Let's take a look at ARM. So that was the original three I mentioned in the intro, but we have two more. ARM is interesting because the daily structure is just so darn clean. Look at this stuff. I mean, just previous resistance turns to support. Previous resistance turns to support. Previous resistance. Do you want me to keep going? Because we'll do it again. Previous resistance turns to support. Previous resistance is turning to support right now. As long as this consolidation can stay over something like 142.75, let's take it on down to the hourly chart here. I mean, just look at this structure building out. Very, very clean stuff. If we could support here, you're looking for risk, reward back to the highs. Or if you want your next Brigade Bolt, you're over 148.25, target 151. Then beyond 151 is where it really opens up again, up towards 161, about 10 points of range to trade for up there. So ARM, probably worth the watch. I got to be completely transparent and honest. I've only traded ARM maybe like 2 or 3 times since it's sort of come on the scene here. This chart structure makes it very attractive here. So I would certainly put this on a semiconductor watch list and bring it in with the top dogs, AMD, ARM, Broadcom, NVIDIA. MU has earnings this week, so we're probably not trading that. But here's AMD, just because I know there's an idea here over as well. The daily 200 SMA is what everybody's watching, right? This is not an original idea. Everybody's watching this. Everybody can see it. But 124.50, if we could pull back to it, it's at least worth a stab looking for some longs there. Right, so that's AMD in a nutshell. And the daily candle from Friday would sort of impose that it is possible, right? You have this big look above and fail, nasty inverted hammer, right, on the daily chart. Look at this thing. Looks over the previous high, closes back inside of this range. If you could get the pullback, I'd be interested in looking for longs around that zone, right? So that's AMD. And the final trade idea, which would round out the original 5 that I was mentioning, is Coinbase. Coinbase has to be a watch. And we could keep going. I mean, there's CoreWeave, there's Circle, all these names we talked about on the Friday pre-market prep. Look at this thing, cleanly holding over these previous pivot highs back here at the $300.75 mark, but also the high from the, I was going to say Thursday, but Wednesday session. Don't lose sight on Coinbase. If it does ever come back down towards this level in here, I mean, I don't want to say just like buy that with both hands, but if this is going to make a constructive move, if this is going to start looking like this, I mean, come on, that's a beautiful, beautiful test of previous resistance, the origin of the breakout, getting out of this balance range. If Coinbase ever comes back, and it may not, But right around that 270 mark, 276 area. If you look on the hourly chart, you can see it as well. This is a pretty straight up move. Not all straight up moves need to be retraced. There's nothing saying that the market needs to. But if we do start to see some weakness through here, the next major support, and once again, the area where I'm looking for it, is down around that 269, 270, 276 area as well. This little local high from back there, right? So that's Coinbase, and that's really going to do it for this week's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, as always, feel free to let us know down below in the comments section or by giving the video a very simple thumbs up. We will be live on Monday morning, as we typically are, 8 o'clock Eastern Time. We'll be up there in the office, pre-market prep, going through the game plan, and we'll specifically look for the ES contracts, really just the futures in general, to see if the roll is a little bit more level-headed and the price action is confirmed on the continuous versus the U contract. We might have to continue using the U contract for a week or two until some more price action develops. What else? The live squawk has been going excellent. If you want a little taste of that, you can feel free to check out the first link down below in the description. We had an awesome Friday, and we're looking to have another awesome week in the books. So with that said, have a green trading week, and as always, I will see you in the next one.